Hello, thank you for joining us here today on landlordsjournal.com on August 21st, 2011. Today we are discussing 1031 exchanges and how they relate to your business. Thank you.
Hello America, and welcome to landlordsjournal.com. The Fearless Foursome is here, and today we're going to talk about 1031 exchanges. A 1031 exchange is a great way to avoid some capital gains and tax burden when you're buying and selling property. Why don't you tell us, John, in a nutshell, about 1031?
I thought Bob had a good.
Okay, anybody, let's chime in.
You chime in, Bob.
Okay, 1031.
Well, I guess if you're looking for the layperson off-the-cuff definition, a 1031 exchange is a way to avoid paying capital gains taxes and a recapture of depreciation when you sell a property. So the classic example is you purchased a property for $200,000. You sell it for $250,000. Depending on the circumstances, that $50,000 is subject to capital gains tax, and then also any depreciation that you have deferred over on your taxes over the years. When you sell it, you're required to recapture that amount. And so those are things you're trying to avoid. A 1031 exchange is something that you have to do with a qualified intermediary, which would be like a title company and an attorney, which is qualified to do this. You would have everything kind of in plan. You would be ready to sell your property. You'd have an property identified. You have to, once you sell it, you have to deposit that money with the intermediary, and then you have 45 days to officially identify the property or properties you're going to purchase with the proceeds of the loan. Of the sale, the proceeds of the sale. And then we just found the date, the amount of time from the time the property is identified. You have 180 days, and John just mentioned that there's no exceptions. In 180 days, flat total must be completed. The sale must be completed.
That's a small window,
you cannot extend that
to avoid it.
And it doesn't matter if it falls on a weekend or a U.S. holiday. That 180 degrees is set. 180 days is set in stone.
I have a couple questions, and I think for the people that are listening to this, a lot of people might not know what depreciation is as far as real estate goes. You want to tell us what depreciation is, Bob? Give us your layperson. You have a lot of experience with depreciation. Tell us what depreciation is.
Depreciation is a deduction that you'll take based on a finite number of years. There's a couple different choices you have when you declare start to take depreciation, but basically you are saying that the value of your property's going down, and so therefore that amount, which is 20 some years, you basically are allowed to deduct that amount from your revenue, and basically it's an offset of taxes that you'll have to pay. And this happens over time. Where it relates to 1031 exchanges is perhaps you've depreciated something and you've received credit of $10,000, then that credit would be recaptured on your taxes the year that you sold the property. And what this 1031 exchange is is set up in order to avoid having to do that, because basically you're transferring that to your next property.
And depreciation is people hear us talk a lot about capitalization, so I could see someone that was new to all this would get confused on, oh, they're capitalizing, they're depreciating, what's the deal? Depreciation is a tax event, is it right? Depreciation is something you do on your taxes, basically, and capitalization is when you get your money back for the property, in essence. So those are two different things. there's a difference between a tax event and revenue event and so on and so forth. And depreciation is a tax event. I mean, we don't literally our properties are not literally depreciating. We don't want them to depreciate. We don't want them to go down in value, but it's a tax thing where we get a credit on our taxes basically. And I think for commercial for property, it's 27.5 years. Anyway, it's a long time. And so if we have a $200,000 building, and the number has to stay the same. If you declare it, I don't think it's what you paid for it, is it? I don't know. I'm not sure how.
It's not.
It's not. It's what you declare, but it has to stay the same.
It's a declared value.
You can't say one. You can't
Once
say when
you
you first
declare
purchased it. It's a done deal. So if you say that it's 200 the first year, you can't say it's 300 in each subsequent year. So then you say it's 200 one year, 300 the next year, then of course your deduction goes up, and they wouldn't look kindly on that. So make sure that if you do that, which you should be doing, that it's consistent throughout your tax returns. That it's not 200 one year, 300 the next year, 400 the next year, which is a mistake that we have made. So we know that you need to be careful with that. But depreciation is different than capitalization.
I have a question, if I might. I think I know the answer to this, but what advantage does Uncle Sam have in allowing this? Why do we have a 1031?
I don't know that I wouldn't think it would be Uncle Sam that would. It's that the movers and shakers that influence the law built this in to protect themselves and to avoid. Capital gains is very important to the elite.
Right.
It's much. And as you make more money, and as you buy and sell, it's a lot more important. It's this important to us. We want it to be this important. We want to be large enough that it's this important. But to some people, it is. And so I think that's the reason. I think that's the reason.
Uncle Sam has compromised with the movers and shakers by saying, okay, we're going to do that, but we're only going to give you 45 days to do it. We're going to make it very difficult for you to do that. So, I mean, I think that was a compromise.
Perhaps where the benefit is that you have to invest in American real estate.
Oh, that's a good point. That's a great point.
And you eventually have to cash out. I think this is not an all or nothing thing. Like this example, if you have $250,000, you have to find $250 or more. That's always written in. You can always go above that, and I think they want you to. So you might invest in something higher. If you don't invest in higher, you're going to be subject to some penalties, some capital gains. So therefore, you will eventually go up the ladder, and I think Uncle Sam expects you to cash out at some point.
Right. I wonder
you
if
will
there
pay
is
capital gains at some point.
I wonder if
is
there a limit on how many times you can do it. Like if you have a property and you keep rolling it over, keep buying something.
I don't know. Not that I've read yet.
It would be very difficult, I think, to.
I've never
to
heard.
But I
find
bet
something.
they would rather collect capital gains on $1 million property versus a $200,000 if you exchange on up. That's what I was thinking.
Right, and it depends on your personal circumstances.
They'll eventually get you. They'll eventually cash.
It depends on your personal circumstances.
Yeah.
I mean, why are you selling it? Are you selling it because you need cash to do something to pay for your kids' education? Then it would make no sense for you to do a 1031 exchange, even though you're avoiding capital gains taxes. It makes no sense for you to go buy another property unless, of course, you were able to HELOC that property and get more money than you would have by selling it. Right. That would make more sense. But it depends on your personal situation. A lot of times, just because it's there and you can avoid capital gains taxes or recapture depreciation, does not always mean that it makes sense.
Yeah.
It depends on what your personal circumstances are.
That's
I mean,
true.
you can go out and, if you're going out and buying something exactly. What if you're wanting to get out of real estate altogether? What if you're a landlord that, I don't even want to do this anymore? Then it wouldn't make any sense. I think a lot of times it just depends on your personal situation. And, it's a one glove doesn't fit everybody kind of thing.
Because you may find a sweet property in a great area that you know is going to appreciate, or you think is going to appreciate,
right.
That's less,
right.
And you're willing to jump on that and take that hit,
right.
or infuse cash to make up the difference,
right.
which is what you can do as well.
Mm-hmm.
But that because you think, oh, well, this property in 5 years is going to be worth twice what it is now, and it depends on the market, like you say.
Right.
It used to depend on the market. I guess it'll come back. But I'm thinking, the Floridas and the Californias and the Arizonas, those types of areas.
But it entirely depends on your situation, and sometimes it makes sense, sometimes it doesn't. Just because you can do it doesn't mean you need to do it or should do it. What do you think, Bob?
Agreed.
I have a property, or let's say I have a property that I want to sell. I don't think that a 1031 exchange will work for me though, because I want to sell it because, well, I have a house I want to sell, but I want to buy a storage building. So I can't do a 1031 exchange. Is that right? Because it has to be like for like.
That's
that
right? I
right?
mean, it could be anything that's basically anything that's real estate. A storage
So like
building,
for
real
like
estate.
is just anything.
I used to, from what I understand, I mean, I didn't used to think that. I thought it had to be
The rules are very
much more
broad,
similar.
it seems.
It looks like the rules are much broader than I had realized.
And
if
there's
it's a storage building or
there's even an IRS guidebook, not guidebook, but there are IRS guidelines that will tell you what like for like really means now. And of course, anything's subject to change with the IRS, of course, but right now it's interpreted very broadly. As long as if it's similar nature and character, you can do it.
Basically, is what we've read is that any real estate, whether improved or unimproved, is what the term showed that we read. It is it's like. So you couldn't. Well, he mentioned earlier our yacht. It's not real estate, so we couldn't go buy a yacht with it.
Right.
Another question that I have is, I'm not an expert. I don't think none of us are experts, but does the person, what do you call it, the intermediary? Does it have to be? Do they have to be registered with the federal government? Could it just be like any title company or any real estate attorney, or do they have to actually be registered with the federal government to perform that function?
I kind of would bet they would be, just like a broker or a title company that's doing. I would think it's very regulated.
It said qualified.
Yeah, it said qualified, which means registered. You would have to be.
That's what led me to believe that they need to be registered with the federal government.
And there are closing costs associated with that, I read as well.
Oh yeah, so, they're going to take their
cut.
cut.
There are fees, exactly.
Yeah.
You will pay somebody to do that for you. And another interesting thing I just read about it is that there are stipulations for relatives. Like if you wanted to do that for your brother or sister, you couldn't do that without there being a 2-year holding period. You couldn't turn around and move it on up. So there are some
Explain that a little better.
stipulations. You cannot exchange into a property being sold by a relative, according to the current rules.
Oh, I didn't know that.
That's interesting.
The related party will be subject to a 2-year holding period.
So you can do it, but you must hold it.
You must hold it. Yeah, exactly.
That's not.
This is
you need to have you will need to have had the property for 2 years yourself before you can exchange it.
Now it says the related party will be subject to a 2-year holding period.
So they need to hold on to it for 2 years. Okay.
Yeah.
We would obviously need clarification on that because that isn't.
This person was asking, an experienced investor told them that 1031 exchanges, he used 1031 exchanges to sell properties and invest the proceeds in new companies that were formed to acquire the assets of businesses that were for sale. And he couldn't find anything to confirm that the tax code allows us as a 1031 exchange. So that
doesn't sound like.
It's more abstract sounding, isn't it? Doesn't sound like a real property, does it?
No. So I don't think that. I don't think
property.
that would. It doesn't sound like an exchange. To me. I mean, it's pretty cut and dry. I mean, really. But like I said, if it just depends on your personal circumstances whether you actually need to do it or not. Here's another one that asked if should triple net lease buildings be afforded non-recognition status in 1031 exchanges. What do you guys think?
What kind of building?
Triple net leased.
Triple net.
What's a triple net
I don't
leased?
understand that term.
I'm thinking a triple net lease building is what we were talking about, is when they take a portion of the revenue of the like at the mall, for example. Not only do they pay the rent or the lease payment or the rent, but the mall also takes, or the shopping center also takes a portion of the revenue. I think you come into that with one of your businesses where they took a portion of your revenue in addition to the rent that you paid. and I'm thinking it's called something,
Yeah.
and I always get mixed up on this, but I think it's
Exactly
called
right.
a triple net lease. So I'm going to look that up just to
I didn't know
make
that was
sure.
a term for it, but
I know there's a name for it, and I know that that's common in commercial property like shopping malls and things where there's actually revenue producing
high retail
cash
districts
business,
in town.
that kind of thing. Let me see here, triple net lease, because you had some experience with that. What was the deal on that?
it
anyway,
was
John?
like I had a fitness thing, and I was subleasing for some space, and I had to pay like a small amount of rent per month, and then a percentage of my income from the business on top of that. So
They wanted to cut it to
they wanted to cut it,
business.
yeah. But then there was a guaranteed, and it wasn't very much. So I don't know. I guess I don't know. Depends on your business. That worked for me.
Okay, just a second. A double net lease. No, that's not. Didn't mention it here. This might have something to do with it, but a net lease requires the tenant to pay, in addition to rent, some or all the property expenses, which normally will be paid by the property owner, the landlord or whatever. So it'd be like us making our tenants pay for the taxes, insurance, in addition to the rent. We would pass through our expenses that we have to them.
That makes sense. Net, you get the full net of the rent.
Exactly. A single net lease, the lessee or tenant is responsible for paying property taxes as well as the base rent. A double net lease, the lessee or tenant is responsible for property tax and building insurance. The lessor or landlord is responsible for any expense incurred for structural repairs and common area maintenance. Roof and structure is sometimes calculated as a reserve amount when the tenant must pay. Triple net lease is what that question was. Is a lease agreement on a property where the tenant or lessee agrees to pay all real estate taxes, building insurance, and maintenance on the property. In such a lease, the tenant or lessee is responsible for all costs associated with the repair and maintenance of any common area. This form of lease is most frequently used for commercial freestanding buildings. However, it has also been in a single-family residential rental real estate used in single-family residential real estate properties. So that's like
A Wendy's.
Wendy's. Like if we own the Wendy's building, they'll use a triple net lease, and they'll pay all that. Somewhere I'm not sure where it fits in there. They will take a portion of the revenue. It's called something. I don't know which one of these it falls under.
Okay, so where were we going with that?
Well, there's a question.
Yeah, what was the question?
Should the triple net lease buildings be afforded non-recognized status as 1031 exchanges?
Can I get a triple net lease building with my?
If you're the complete owner of it, I don't see one.
Well, who's taking depreciation on a triple net?
I still don't understand the term. I would just say the owner is. I don't understand.
You would think that the owner would be.
But remember the
leasee is paying.
It's paying
for
the taxes and.
At least he's taking all the burden of it, isn't he?
That's how you. Yeah. I don't know.
Well, it's sort of like a lease option. I mean, in a way, because they.
Minus the options.
I mean, the lease option you.
Well, the reason for that is that it's a 100% deductible expense. That's the reason you do that as a business owner. That's why not everybody owns
my
their.
hand around that.
Well, it's
Too much math this early.
on a normal ownership. You can depreciate it. You can do whatever.
Mm-hmm.
But on a lease, that's a business expense, and so 100% of the cost of that you can deduct 100% of the cost of a lease.
Okay. In addition to depreciation?
No.
Of the property? No, it's an either or.
Yeah,
Right.
that's
Okay.
what I'm saying.
I gotcha.
So probably it's still the owner that could do the 1031, but I don't know that.
Well, what was the answer to that question?
Advanced.
That is
that's
advanced.
That's the 600 level.
Yeah,
course.
that's advanced. I don't think we're any.
We're not ready to
Yeah.
start that
to
yet.
do that.
Well, just to muddle the waters, I was reading.
Yeah.
And there are things called reverse exchanges. We're not going to go there.
Give us like the.
And they are legal to the IRS. I don't know.
So what's the essence of it? What do you?
I don't.
What's the, you don't even know the
I'm not
point
going
of
to talk about it because I can hardly say those words. I don't know.
Oh, really? It's that bad?
we're not. I'm just mentioning that.
So can you move into the, like, say you bought a duplex on a 1031 exchange? Can you move into one of them?
Absolutely.
You can.
Sure.
I don't see why not. So we're
But
talking.
you'll still get you'll still get the exemption. I mean, you can move. You can do what you want, but you still get the
You pay
exemption.
yourself.
Oh, I don't know how
Deduction.
I don't know how the mortgage exemption works on not a single family home. I don't know.
Because wasn't there's a 2-year rule for getting a home sale exemption, right? From a gain. Isn't there a 2 year?
Yes.
Yeah. So how would that apply if it was a piece of investment property?
I don't know.
I don't either.
So is this 1031 exchange, is it something that, does this apply to like when a private individual sells their house and buys another
No.
house?
No.
And
And
that
that's
would
the
fall-
reason. And the reason for that is it's a different kind of deduction. And typically, now let me restate that. There's a capital gains exclusion on your personal residence after you've owned it for a defined period of time.
You don't have to pay
Right.
tax on capital gains if you've
owned it
house.
for at least 2 years.
I see. Okay. Even if you don't buy another property, if you
Right.
just liquidate it.
Right.
I see.
So is it possible to do a 1031 exchange on a property that you plan to sell with a lease option or under financing?
Sure.
So, but you actually have to receive the proceeds, wouldn't you, first? You don't have to.
Now let me make sure I understand what you're saying.
Because you're basically acting.
Oh,
as
I thought
the
you
bank.
meant getting a new property that you're going to do. Read that again.
It says I have a property home in which I'm putting on the market. If I sell the property on a lease option to buy or under financing, would I still be able to do
I
a
would be
1031
astonished.
exchange? If so, then how and when upon signing the contract or payoff?
I don't know.
2 years.
That's a
For
good
one, I mean, it sounds like it's a home. Which
Well,
you
remember,
wouldn't-
that's taxable. That's taxable to you, even though you've not collected it yet, because you're treating it like a loan. So you've collected the proceeds of the sale, and then you're loaning it out. You're mortgaging. You're putting a mortgage on it for the other person. So it sounds reasonable.
Which we never discussed this, but aren't there usury? I never can say that word. Is it usury laws that govern, like, if we're loaning our own money and charging interest rates, and I mean, aren't we supposed to be governed by? Aren't we supposed to?
There are, and I don't know if there's any federal. There may be federal,
I'm not
but
sure.
there are definitely state.
There's
definitely state laws which limit. But I don't know if that has to do. I don't know if that's true with.
I don't know if that muddies the waters any. With
Yeah,
that.
we're really rabbit trailing.
Do what?
Mm-hmm.
Rabbit trailing. What do you mean? I mean, these are valid.
I
This is
know.
valid points. We're talking about 1031 exchange. We're not.
Okay.
We're actually staying on topic.
So we might actually use this with our own, just to bring it back to a personal standpoint for
Yeah.
us. I could see how this could be advantageous for us because we're not looking to cash out.
Yeah.
You know,
If we ever
anytime
sell a
soon.
place,
So we could sell like everything, and as long
Yeah.
as we spent the same amount of money or more, we'd be okay.
you just have to do it within a certain amount of time.
Right, which it would be
That's
very.
the only
That's
thing.
that's difficult, I would think, to do, because it takes us 6 months
So you would just have to.
to make an offer. I mean, I think it'd be difficult to.
You might have to do a lot of pre-leg work and then, like, kind of arrange it and then, set your date. I would
Right. So what's the ideal situation, Bob?
for a 1031 exchange.
Yeah, I mean, do you have something already ready to buy? And
I
ready
think
to
you
sell?
would, unless
say
you wanted
so.
to risk running out of the 45 or 180 days. I think you'd have to.
Like maybe a foreclosure option might be good. Like a foreclosure that's maybe more like a good foreclosure.
Mm-hmm.
That's cheap, that the bank's willing to get rid of, but equals about the property that you want to exchange. Maybe that.
Why
would be,
foreclosure? I'm not.
This is an example. Just as an example. You know, because
Something
then
that
because
has instant equity, maybe.
because you've already done some legwork on that. Maybe your real estate agent or your bank person is giving you a heads up. You know, we've got some properties coming on. Oh, let's research these. Okay, yeah, I want to be able to move on that. Yeah, let's do.
Right.
You know, doing some pre legwork, doing some due diligence
Right.
before you actually start that 45 days.
But you actually have to close and own the property within
180 days.
180 days, which 6 months. I mean, that sounds more reasonable.
And I was also looking in here, and somehow an escrow company needs to be involved. There's a qualified person, but then an escrow has to be in there for the title exchange.
So two separate entities.
Yeah.
Well, and
Be
they hold
involved.
the proceeds until they hold the proceeds until you purchase the next property.
Yeah.
So
Because you can't just put it in the bank and then pay it.
Yeah, you can't
I could see that. That makes
bring
sense.
it out and put it in your general fund.
Right.
Right, because then it's definitely taxable.
Yeah. So there's really, it's pretty much cut 1031 exchanges. I mean, there's a lot to it, and there's more to it, of course, but I think that you really have to have your stuff together before you
Yeah.
before you start doing. You have to, yeah. It's not as easy as it sounds. I mean, you have to have something lined up, and again, it has to make sense for you. Sometimes.
And it said, what I was reading, there's all kinds of qualified intermediaries out there, but you need to do your due diligence with them too and make sure they're bonded and that their insurance is up to date.
Yeah.
Because if something happens and there's a loss of money, somebody gets sued, or you might have to,
What
take
if
some
you
legal
had-
steps against. You just need to be careful who you ask to do your work.
What if you had two companies? What if you had one company that had some real estate property in it, and you had another company that had some real estate property in it, and you got it, and one of your companies got an offer. Someone said, "I love that property. I want to buy that from you for $250,000," and you were thinking, "That sounds great," and I paid $200 for it, and I want to sell it. Okay, could you take the proceed? Could you do a 1031 exchange for that property, for one of your properties that you got over here?
Absolutely. They're
Different-
totally
bring that
different
property
entities.
over
That's
to
a
there.
different person.
Bring that property over there.
You're not
So if
related.
you had two companies, if you had two different LLCs and they had properties, if you ever sold one here, you, by definition, you could always
Of course, all you're
have
doing.
one here ready to do
that's
the
a
exchange.
that's a reverse.
Is that a reverse?
Hang on, let me read
That's
this.
interesting.
Okay, reverse. This is the type of exchange in which the replacement property is purchased before the sale of the relinquished property. But it doesn't. I don't know what that. I don't know
Well,
what the rules are for that.
That's
There must be
interesting.
some very strict
The reason
rules
you
on
would do that, you might do it as an emergency stopgap.
Yeah.
I mean, because otherwise you're just paying a fee to your qualified broker.
Yeah.
That's not necessary. So
But what you would be doing would be saving
avoiding the
capital
taxes.
gains.
It depends on what you. It depends on how big your capital gains are.
Yeah. If you were going to pay $50,000,
It'd have to be a sweet deal, like you say, for that to make sense, right?
Well, it depends on how much your capital gains are. If your capital gains are going to be $50,000, you got some massive property, then I'm sure it would.
So what if any one of us? I'm trying to if any one of us wanted to sell, like if Donnie had something, his stuff, or you had something, or our apartment building, we wanted to sell it to to be considered a
Transfer.
You know, like say we wanted to sell, say we were getting the apartment building for $500,000, which just some arbitrary easy number, which we wouldn't do this, but $500,000. Okay, would that? So we transfer the the numbers make sense. It meets our criteria, or the company criteria for capitalization and so on and so forth, and it's a good deal, and we agree that blah blah blah. Would that be considered like a transfer of property into the company? Because when we do our taxes, they ask if we're transferring like personal property into the company. that we...
I think you can round it up either way.
And then how would we do a 1031 exchange?
I think
on
you would have to assume
on a
that
personal level?
you're looking for other property to exchange for that too. I think that's the difference, right? You've got some property on the back end that you're exchanging for.
Yeah, that's whether you would
building.
do it or not.
But there's two different entities. I mean, even though we're
Well,
involved
but you
as a
can't say
company.
both. You can't say it's a transfer and then there's no purpose. If it's a transfer, you're not subject to capital gains on it.
That's what I mean. So could you like keep the difference and say,
Keep
well,
what difference?
The difference between, like, say that we're transferring ownership, which means that the mortgage.
Oh, I know the difference. On a transfer, you're not collecting cash.
On a transfer, you collect title,
Right, but
you're not collecting. You won't
you're
collect
not,
the difference.
You're not collecting cash. That's the difference.
So on a transfer, you wouldn't collect cash.
Right.
On a sale, that makes sense. On a sale, then you would collect the difference between
Right.
what you sold it for, and what the
Mortgage.
what the
But those
whatever
proceeds with a 1031 still have to go towards another property of equal or more.
Yeah. So
value.
in turn, could you do that?
I mean,
Take the
you'd
proceeds
have to
of
Of course you
complete
could.
the
and then
steps.
invest
It's
it.
a sale
But this is where
from
that one question
entity
was.
that's not a family member.
Oh wait, okay, but this is where I was getting at with this one question was, could you in turn take that money, like the difference between whatever the example, another company that you're related to, and do a 1031
Purchase.
exchange through them, because that's what they were saying. That's basically, so you'd actually be investing with a business,
Yeah, I don't
which
think
would
you
make
can
it
do
difficult
that.
to do a 1031 exchange. Even
You're
though
not buying a property.
So you would have to buy it.
It's
under,
not real estate.
You'd have to buy it under whatever name whatever. If you buy it under log exchange, under log, right, and say I'm going to do
I wouldn't
this.
think so. I would think that would
my
be.
thing.
That'd be the evasion.
That's what that question. I think that's what that question was. It would actually be a. I don't think you could do that. I mean, I don't know.
That's kind of.
That's more advanced. None of us are CPAs. Huh. I know I'm not.
Well, it sounds interesting. I'd like to kind of try one once we get to the point when
Yeah.
we want to offload.
And it's
If
that
we
whole
get- if we get
question
a
of whether
property that
it
we're not in
makes
love with,
sense.
that's
Yeah.
our problem.
But it's a
Is
whole
we buy all
question.
these
By the time
properties,
we're
we
so
like all the ones
invested,
we have.
we get so invested.
or
Yeah.
they're making so much
Yeah, for that reason.
so
yeah.
much profit that
And
It'd be
it's-
stupid to get
we
rid of
get.
them.
we love
non-emotionally
Yeah.
attached.
Yeah, we get.
It's that question again, though. Are you better off refinancing it or selling it? I mean, it's that you get more money a lot of times by just taking the difference and HELOCing it than you would if you just sold it and paying capital gains taxes. And the 1031 exchanges are so complicated.
Yeah. I mean, you might do that. It might be crazy people doing that, but I would imagine you have a property already in your sights
You've
before
already
you
done your
sell
due
it.
diligence, like a foreclosure or something.
Well,
You've got
you
something
don't
in your
you
lap.
just because you just don't buy something to save money. It's like you're spending money to save on taxes. I mean, you just don't go and buy another house and more.
Well,
and just to save on capital gains taxes.
right.
That wouldn't make
the
sense.
cash flow
either.
may be better at the next place.
That's what I mean.
It's
It
gonna
has to make
appreciate
it has to
maybe.
make sense for you personally.
Well,
and
Right.
you don't take advantage of the 1031 exchange that you missed the boat and I mean, a lot of times it just does not make sense, and that's the point I wanted to make. A lot of times 1031 exchanges don't make sense for everybody, and it's not an absolute necessary. It's not absolutely crazy if you don't take advantage of it. Sometimes it just doesn't work out, right? I mean, do you guys
Right.
agree with
No,
that?
I do agree with
Sometimes
that.
it just doesn't work out. It depends on your personal situation. What
It's all
you're
about
wanting
being
to
a
do.
creative investor.
Exactly. It's all about being a creative investor,
Which we are.
like you said, which we are. And that's our 30 minutes.
At
Okay.
least.
Well, America,
it's
there
good.
you have it. That's the 1031 exchange. It's crystal clear to me now.
We're ready to file our papers.
We're ready to do one.
We're going to do our paperwork.
Okay. All right. Bye-bye.
On landlordsjournal.com. Join us next week when we continue our discussion on taxes and capital gains and how it relates to flipping houses, something that we want to get involved in the near future. So be sure to join us next week, and also be sure to check out our website on landlordsjournal.com. Thank you.